After the spectacular jump of almost 400% in just a few days, Hycroft mining became one of the most popular stocks so far in 2022. Is the stock going to keep rising? Should we hold it long or short term? And what should be our immediate trading strategy? In this video, we're going to talk about Hycroft Mining Holding Corp, trading under the ticker symbol HYMC. At the moment, the financial market is very volatile, and we have to be careful about which stocks to pick, as well as the exposure and the timing of our trades. This video is going to cover the recent price actions and the technical aspects of the stock. Before today's video begins, a quick heads up that my analysis is based on sessions already completed, and that it may not take into consideration the latest events. If that is the case, I will make follow-up videos to reflect them. With that being said, let's begin with today's topic. During the most recent trading session, the stock increased to $1.33 before closing the trading day at $1.24. We should pay attention to the $1.21 level nearby because it was tested as a relatively significant support level in the short term and can be used as a benchmark to determine if the bulls are able to hold the grounds. Over the past 30 days, the trend of the stock has been clearly bullish because the market has been made aware of the stock's potentials both as one of the largest gold deposits in the United States and as a short squeeze stock with the involvement of many hedge funds. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock has been bullish, despite the fact that the price action of the stock has been on the volatile side of things, and may see its volatility rising still in the upcoming weeks and months. When we look at the price trend overall, it's been slowing down compared to the past few weeks or so, and the stock began actually pulling back from its peaks since there were some shareholders who chose to unload at a relatively high price point. We gotta wait and see whether the price action can pick up once again in the upcoming days. For now, I think that it's gonna keep pulling back. The trading volume of Hycroft Mining has recently been 40 million shares compared to the average volume of 74 million shares. Over the previous 52-week period, its price fluctuated between 28 cents and $7.42. The market cap of Hycroft Mining is currently at $82 million compared to the enterprise value of $229 million. The difference between the market cap and the enterprise value is the premium or discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or has a negative image amongst the market participants, the asset's value may be impaired. With that being said, at the end of the day, it remains an estimation of the market every time it publishes its financial statements. So it's less reactive than the market cap and often more lenient for startup companies as well. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is the goodwill. Goodwill is an expectation of the market that the company can generate more profit or have more growth than another company, partially because it may have a better management team, a stronger brand recognition, and a bigger online following. It's basically what makes one company unique compared to the alternatives. It's not a tangible asset that companies may use, it's often the reason why some companies are perceived to be trading at a discount, since the market cap is lower than the enterprise value, because the enterprise value is less reactive to the market cap in very volatile situations. So, if the company goes to liquidation, the goodwill would be gone, and we would be left with potentially less assets to share with bondholders than what we currently see on the balance sheet. When we compare the current price to the historical price fluctuations, the stock is 336% higher than the 1-month low, 336% higher than the 3-month low, and 336% higher than the 52-week low. On the options market, which often gives us a hint on the market sentiment about where the stock price is likely going to head toward, the implied volatility is 241%, compared to a historical volatility of 446%. The put-call volume ratio is currently at 0.36. It is normal for most stocks to also tend to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 24,000 contracts a day versus the 30-day average of 16,000. In terms of open interest, the most recent volume of open interest is 77,000 contracts versus the 30-day average of 26,000 contracts. For the shareholder structure, institutional shareholders own about 60% of the outstanding shares. The biggest shareholders include White Box Advisors, Nomura Holdings, and Vanguard. It's relevant to understand the shareholder composition of a company because it helps to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. It's obviously subject to a lot of exceptions since many great companies are mostly held by retail investors as well, but that tends to be the exceptions and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there are significant short interest in the total volume, it can be a sign that there's an organized shorting operation going on, like what happened with GameStop and AMC. The current short interest is 15% of the total float and 42% of the transactions are off exchange. Overall, my opinion on Hycroft Mining Corp is bullish, as the stock is now gathering a large quantity of attention from the retail traders and some hedge funds as well. I believe that the short-term momentum is going to be unquestionable for Hycroft Mining stock because a lot of people are expecting the shareholders to squeeze out the short sellers. Long term though, I think that there's going to be a slightly harder argument to hold it for a prolonged period of time. The maximum exposure I would recommend is between 1 to 3% of your portfolio. For the immediate term, my recommendation is to buy the stock, considering the recent price actions and the promising price levels that are close to where the stock is right now. Just be careful, you should be expecting further pullbacks. It's not guaranteed to happen, but you should be expecting it. I would recommend to separate the allocation in batches of 10% at a time so that you can have enough room to purchase later as well. And this is particularly important given that, like we said before, we are expecting the stock to keep pulling back after such a giant peak. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.